Investments in securities are subject to market risks. Read all related documents carefully before investing. Hello and welcome to the Weekend Investing Daily Byte. We are shooting this episode on 9th of May, and a confusion of sorts in the market where the prior run of the market did not really carry through today, and a lot of disappointment in various pockets of the market. But there is valid reason for that, and we'll go through that. Overall, if we see the Nifty has not dropped even a point from where we closed yesterday. So from that perspective, Nifty is very, very strong. There is no reason to doubt this uptrend. Until we break this bottom now, I think we are going to remain bullish about this uptrend going up. But below this congestion zone or below this trend, this neckline of the inverse head and shoulders, that is the point where one may start to get worried about this uptrend. But till then, I don't see any reason to be disappointed about today's move. So we are just resting here after a good run up on two sessions. Of course, we had a tough Friday in the middle there. Uh, Within the Nifty heat map, you see that some larger weighted stocks came down, like ITC, Bajaj Finance, State Bank of India, along with Hindalco, Grasim, JSW, Sun Pharma. But other than that, we had a reasonably sideways day. Reliance being sideways, Hindustan Levers, TCS, Infosys, HDFC Bank, not going anywhere. Maruti, Tata Motors, and Mahindra trying to creep up a little bit. HDFC Life, IndusInd Bank, Axis Bank also slightly up. So nothing lost in terms of the ongoing momentum. Some correction in some pockets at some point. ITC results are due on the 18th. It has run up quite a bit, and hence maybe some profit is getting taken off there. uh, State Bank and Bajaj Finance also coming off after a run. But the point to note here was that within the sectoral overview, IT remained the top gainer of the day, which is very surprising, but that's what the case was at 0.7%. Autos also doing quite all right at plus half a percent. Pharma up 0.4%. In fact, there was a very good listing of Mankind Pharma in the markets today. And other than that, a lot of sectors just going nowhere at plus 0.1 or minus 0.2%. But PSU banks, that is one space that got hit today, minus 2.8%, and it was also hit yesterday. So over the last five sessions, PSU banks are down now 4.4%. Although the results have been quite good, but maybe the market expectations were even further, and that's where some disappointment or maybe profit taking has come in there. Real estate also has been running very hard in the last 1 month. You can see the 1 month gain is 11%, so some bit of profit taking also happening there. So nothing really has gone wrong or bad, just market is taking some rest here. Mid caps, you can see again, while the close was off the highs, but it is still higher than the previous session. A phenomenal run so far, a great run here, small flag here, great run here. So this is sort of, getting jittery near the top. That's about it. We may have some jitteriness here, and once we break out, it will be a very fast breakout. Small caps, as I've been mentioning very rightly, today clipped the trend line and just went down from there. So first 15 minutes actually, it went up and clipped this trend line from March 2022. So significant trend line that I've been showing for the past many episodes, and you can see that there was just a fantastic waterfall down after that, almost a bearish engulfing on the previous day. So small caps probably will remain a bit cautious here until we are able to break out of here in due course of time. Nifty Bank also a bit iffy after this move on Friday, which was an extreme down move backed by HDFC Twins losing a lot of ground. Yesterday was it tried to claw back up type of a day, but it still remained an inside bar. And today also the closing was below yesterday and still within this long bar that we got. So until we break out at above 43,600 or maybe below 42,800, we probably will not know which direction we are headed to. But again, we are still very near all-time highs, so nothing really has gone bad as such. Still quite healthy market in those terms. The odd movement that was spotted today was on USD INR. So USD INR, which has been simmering at 81.60, 81.70 for a while, today suddenly jumped from 81.60.70 to 82.10. We don't know why, but that's how the movement has been there. Maybe there is some FII selling that happened. Maybe there were market rumors that BJP may not do so well in Karnataka, and that may have been the reason why some positions are being squared up or being built ahead of that decision. Anything could be there, but significant change from previous sessions, the move in USD INR. So today's discussion is about this article by Raghuram Rajan. Raghuram Rajan is a former governor at Reserve Bank of India, a very prominent economist. So he says that he's worried about a time bomb and a domino impact, and sort of a riskless capitalism is happening in the world. So let me first say that I pretty much subscribe to the thought process here. I may not agree with Mr. Rajan on everything, but I very much agree with these points of views that we are sorting out very short term problems, but the long term problems remain where they are, or in fact getting even deeper into the crisis zone. But we are only dealing with whatever comes in the short term as a measure to just kick the can down the road, so on to say. So some of the quotes from this article, and he says that I think the short-term problem has been dealt with by the implicit insurance of all deposits, but long-term problems still exist. So what is happening, and this is more in terms of the US context, and we look at US context because that is indeed the mother market of the capitalistic world. If US markets get hit, and whatever strength any country has in terms of its markets or growth, it will get impacted. I mean, there is no two reasons about it, two ways about it. So what has been happening in the US is that all these regional banks which had accumulated assets, so assets meaning they had invested in various kind of treasuries or they had liabilities at near zero term rate. Now what has happened is that the Fed has increased the rates at a fastest pace ever, and I'll show you a chart on that. So from near zero to near 5%. So what, and you know very well that when interest rates go up, the bond asset valuation comes down, or your loan asset book, the valuation of that will come down. And if you mark to market that loss, you will have losses on your balance sheet. Now, what the US banks have done is that they did not really take care of the duration. So you have short term depositors in your bank who have given you money, but you have taken long term assets which have for now eroded in value because the interest rates have gone up. So now, if even a small portion of depositors start to withdraw from the bank has no money to pay them because the bank has locked its money for 10 years, 20 years, or 30 years. And that is exactly the problem that most of the banks are having, that they are becoming insolvent. So, what the Fed has done is that they have opened a window to all these banks, and first of all assured all depositors that none of the depositors need to worry because all the deposits are insured. So just by a wave of a magic wand, $17 trillion worth of deposits have been told that you are insured. There is no way they can insure it, but they have been told that you are insured. uh, and it is all a matter of confidence. Now, these banks can now put their assets, which are currently at mark to market losses with the Fed, and get par value from the Fed. So if $100 asset is today $60, you can give that $60 asset to the Fed and get $100 short-term liquidity against that to make sure that your depositors, if they need the money, they can get the money. So this is the kind of system that has come around, which is absolutely not sustainable. Just imagine banks who have liabilities, who assets who have which have inferior quality can put those assets to the Fed and get full liquidity against that. So this is like the banana republic of all nations, where they have the reserve currency, and so they can keep printing and keep backing up whatever damage comes their way. So it is not only a short-term systemic problem if deposits remain uninsured, but also a long-term profitability problem. So now, how does banking industry profit? They will take depositors' money. They are currently taking it at 0.5% or 1% deposit rate and deploying it in long-term bonds at 1.5%, 2%, and sort of having that margin on for themselves. Now that margin is also gone for whatever they've invested, because all their assets are in mark to market losses. So there is a issue of profitability of the banking sector itself. uh, Significant increase of uninsured liabilities in the banking sector of the last couple of years as a result of enormous quantitative easing. So they kept printing at 0%, giving it to the banks at very low interest rates, and the banks, further, and the stimulus went to the people who put that stimulus in the banks at 0.5% deposit rates. These banks then put them into 30-year to 20-year, 10-year treasuries at 1%, and now that treasury has been marked down. So this is a major issue of liquidity that is happening. And if Fed keeps on backing, every time a bank gets into trouble and the Fed says, okay, don't worry, here is all the liquidity that you need. So basically, that liquidity is essentially pumping more and more money into the market and diluting that dollar base that already has ballooned so much. So there is no current way where this printing can stop, and unless we want the market to sort of break down. So, and businesses are finding it difficult to pay back loans. So what happened in that 4 or 5 year period where the rates were near zero, everybody borrowed like crazy, and now to pay back those loans, because interest rates are rising, it is becoming more and more difficult to do that. So he terms it as a zone of riskless capitalism. So basically, banks really have no risk. They can take on the riskiest of assets, but they have the Fed to back them up. Only the shareholders of those banks will get wiped out, but depositors and the bank administrators really have no risk from that perspective, and the bank can take the riskiest of bets to make sure that they are profitable. But in case it works for the bank and for its shareholders. But if it doesn't work, then the shareholders have to pay for it, the equity holders. So it is sort of a very you can say unsustainable sort of a setup. And Mr. Rajan says that the concerns are there that banks will be the first domino to fall, and we have seen how three major banks in the US have already fallen. There has been a catastrophe at Credit Suisse also, and this is not over. So this is just, you can say that for the time being, that fire immediate has been doused out, but it is simmering somewhere else. And so where it will flare up again is anybody's guess. It could even be private equity, where there is a lot of duration mismatch, and a lot of destabilization can happen. So he terms it as a simmering time bomb. And the other issue that has not even been discussed here is the commercial real estate, which is, very recently there were news that people are having to sell off their commercial real estate at 50, 60, 70% mark off from last couple of years. And that kind of markdown will definitely impact a lot of lending. So was a news item that 722 banks have unrealized losses, which have over 50% of the capital of these banks. So this is the kind of a sort of simmering time bomb that is brewing. And this red line is what you see is the rate of hike of interest rates this time. These were all the prior hikes. So you can see that the prior hikes, uh, even till 3%, from near 0 to 3%, used to come in 10 to 16 months, even in one case, even 36 months for 2% rise. But this time it has gone up like crazy. And of course, when you give such a shock to the system, but you don't allow anything to fail. So, you can't have it both ways. You're giving a shock to the system so that something fails, but then from the other side, you're saying we will not allow anything to fail. That, I think, is a model that at least I don't understand. And this is not just in the US. The European Central Bank is also facing similar sort of a situation. And you can see the central bank balance sheet assets in the Eurozone, which had also gone into the red many times okay, in the past, are the steepest in the red, minus 1.1 trillion. So you need to keep pumping money to increase your capital base, so that you can balance out these short term and long term losses. So this is becoming a very, very unsustainable sort of situation. This will probably ensure that money printing will have to continue for forever, till this entire monetary system breaks down, or some Bretton Woods system, Bretton Woods 2 happens, where all central bankers come together and reprice their other assets on their balance sheet. The only other asset that they have is actually gold. So this is something that, why I'm giving you all this sort of philosophy here, is that we should not, when we are trading or investing in the India market, be totally clueless about what is happening in the rest of the world. This is actually the core of those things. And if this time bomb goes off, then everything goes off. You can forget about your P's and EPS and moats and market share and all those, anything, cash on hand, anything. All boats will collapse when the tide collapses. So this is something that you need to, I wouldn't say worry about, but be cognizant about what is happening in the world. So in my and I'm no expert on this, this is just my reading on it. Please go and read more. I think the world is a very, very volatile and uncertain place, much more so than even a decade ago. So we need to continue with cautious optimism. So definitely take bets in equity, definitely allocate towards equity, but don't go overboard. Don't go, I'll go because India is growing at fastest pace amongst all the rest of the world. So I will, bet my house on the equity. Please don't do all those kind of super leverage things. Invest what you can lose, or at least can live with losses for several years in case they happen. Consider asset allocation, very, very important. I talk about asset allocation on a daily basis. Take insurance of all kinds for your equity portfolio. Gold is the best insurance that you can have. And do not ignore the risk of what is known today. This is very, very important. We can be blinded about everything is good, and whatever we can fathom in all directions is all good, and hence everything is good. But we also need to consider what we don't know. So what is not known to anybody, that risk exists, and you have to you know take cognizance that that risk can also come through at some point. And if that comes through, how will you protect yourself? So with that short note on the time bomb thesis of Mr. Rajan, to which I largely agree, I would like to come to an end to this episode. Thank you so much for watching, and I hope you continue to send your comments and your feedback on these episodes. Thank you. Bye.